You've heard it a million times, right? Cash is king. But what if I told you that most businesses have a ton of cash just trapped inside, hiding in plain sight? Well, today, we're going to talk about a really clever tool designed to unlock all that hidden value. It's called supply chain finance. All right, so here's our game plan. We're going to start with the why, the big problem this whole thing solves. Then we'll get into the solution, break down how it actually works with a super simple model, introduce you to the key players, and wrap up by looking at the bigger picture, why this really matters. Okay, let's dive into section 1. Before we can really appreciate the solution, we got to understand the problem. And it's a huge one, a cash crunch that squeezes small and medium businesses all over the world. So, let me ask you this. Why do so many good businesses fail? You know the ones I'm talking about. That great little coffee shop or a startup that seemed to be doing everything right. And then, poof, they're gone. What's going on there?
Well, a lot of the time, the reason is kind of shocking in its simplicity. It's not that they aren't making sales, it's that they run out of cash. There's this massive, painful gap between doing the work and actually getting the money in the bank. That's the cash flow crunch.
And this right here, this is really the heart of the issue. This whole sell now, get paid, eventually model has become the default way of doing business. I mean, look at this stat from China. By 2013, 90% of B2B sales were on credit. That's insane. It basically forces all these small suppliers to become tiny little banks for their giant customers. And if that wasn't bad enough, here's what happens next. A staggering 82% of those companies that are extending credit, they end up getting paid late. You can just imagine the stress, right? It's like this wave of financial anxiety that just ripples down the whole supply chain. So this brings us to the core disconnect. When a small business, an SME, goes to a traditional bank for a loan, what does the bank see? They see a small, risky company with a weak balance sheet. But the supply chain finance perspective completely flips that. It doesn't look at the small business in isolation. It sees a crucial, trusted link in a chain connected to a big, powerful, and very reliable buyer.
And that change in perspective, that's everything. It's the secret sauce that lets supply chain finance unlock all that value that's just sitting there, trapped in unpaid invoices. So let's get into how it actually works.
Okay, so what is supply chain finance exactly? First off, it's not a loan in the traditional sense. Think of it more like a system. It takes an invoice, one that a big, credit-worthy customer has already said, yep, we're going to pay this, and it turns that piece of paper into cash right now. And usually for a much, much better rate. Here's a great way to think about it. A normal loan is like a really tough job interview for that small business. The bank is judging them all by themselves. But supply chain finance, that's like getting a glowing 5-star reference from your most important client. The bank trusts that big client's promise to pay way more than it trusts the small company's balance sheet. And for the lender, that means the risk just plummets. Okay, so how does this magic actually happen? The whole system can be broken down into 4 critical steps. And to make it easy to remember, we've got a simple acronym for you: data. It's super straightforward. D is for data. You need real-time data from invoices and transactions to prove a real business relationship exists. A is for the anchor. That's the big, creditworthy buyer who approves the invoice and guarantees they'll pay. The data plus the anchor creates T for trust. Now the lender knows this is a safe bet. And that trust turns the invoice into an A for asset. An asset that was stuck in illiquid is now unlocked and turned into cash. DATA, that's the whole engine right there. All right, that's the model. But let's see how this plays out in the real world. Who are the actual players in this ecosystem? It's basically a 4-sided network. You've got the supplier, the small business that needs cash now. You've got the buyer, or the anchor enterprise, a big, stable company. Then you've got the platform provider, a tech company that acts as the digital glue holding it all together. And finally, the funder, which is usually a bank that brings the liquidity. It's a true partnership. So let's walk through a real example with Big Lots. Here's how it goes. Step 1, a small supplier sends an invoice to Big Lots. Big Lots approves it on a tech platform, let's say one from a company called Prime Revenue. Step 2, the supplier sees that approved invoice pop up on their screen and has the option to get paid early. If they say yes, Step 3, a bank in the network zaps the money right into their account, minus a tiny fee. And finally, Step 4, when the invoice is actually due, say in 90 days, Big Lots just pays the bank directly. See? The supplier gets paid fast, The buyer keeps their payment terms, and the bank makes a safe, low-risk return. It's a win-win-win. You know, the really big deal here isn't just about getting slightly cheaper financing. It's about control. It's about getting rid of all that uncertainty. The supplier can look at their screen, see exactly which invoices are approved, and decide to the day when they want to get paid. That predictability, that's gold. It lets them sleep at night and actually plan for the future. Okay, so let's pull back and look at the bigger picture. This is cool for one company, sure, but why does this financial tool really matter? What's the impact on the whole economy? This table just lays it out so clearly. It's a complete shift in thinking. The old way looks at a small business and sees risk, opaque information, and an isolated company. But the supply chain finance view sees low risk because it's backed by the big buyer. It sees transparent data from actual trades. And it doesn't see an isolated company, it sees one part of a strong, interconnected network. It's a totally different way of defining value. And when you make that shift, you get this amazing multiplier effect. First, you strengthen the whole chain. Financially healthy suppliers are reliable suppliers. Second, you lower costs for everybody because the financing is so much cheaper. And third, and this is the big one, you unlock billions of dollars in trapped working capital. That's money that can now be used to hire people, to innovate, and to grow the economy. It makes the entire system more efficient and way more resilient. So when you boil it all down, this isn't really just a story about finance. It's a story about how real-time data can create trust where it didn't exist before. And it makes you wonder, right? If this one idea can unlock so much hidden value in our supply chains, what other huge, long-held business assumptions are just waiting to be completely transformed by a similar shift in thinking?